For decades, macroeconomists spoke about the sovereign debt death spiral as a theoretical ghost, a cautionary tale for future generations. But this morning, as the interest payments on the U.S. national debt officially clipped the $1.3 trillion annual mark, the ghost has become the landlord. To put this in perspective, we are now spending more on the cost of yesterday's debt than on the entirety of our national defense budget. For the first time in modern history, the most powerful nation on earth is spending more on its past than on its future protection. I've spent the last 48 hours reviewing internal data with my head of research, a strategist we'll call Silas, who specializes in cross-border capital flows. What we are witnessing is not a standard market correction. It is a structural failure of the fiat currency's primary engine. In 2024, we worried about $34 trillion in debt. In 2025, we debated the sustainability of $38 trillion. Today, in mid-March 2026, the global market has finally realized that this debt will never be paid back in units of equal purchasing power. It is being liquidated through the systematic destruction of the currency itself. Let's look under the hood of the central bank. As of today, the Federal Reserve's operating loss has ballooned to approximately $268 billion. In any other sector of the economy, this would be defined as terminal bankruptcy. But the Fed has employed a specialized accounting gimmick known as the Deferred Asset. Think of it as a IOU to themselves. They tell the Treasury, "We'll offset these massive losses against the profits we hope to make in the next decade." But here is the 2026 reality. There are no profits on the horizon. With oil prices stabilized at $118 per barrel due to the persistent friction in the Strait of Hormuz, inflation is no longer transitory. It is the baseline. The Fed is currently caught in a lethal pincer movement. If they lower interest rates to prevent the regional banking system from collapsing under the weight of commercial real estate defaults, inflation will spiral into the double digits. If they keep rates high to protect the dollar's international standing, they bankrupt the very government they are sworn to fund. They have chosen the latter, creating a liquidity vacuum that is sucking the life out of every traditional savings account in the country. Geopolitics in March 2026 has become the ultimate accelerant. The maritime conflict involving Iran is no longer a localized issue. It has fundamentally repriced the energy delta of the entire planet. While the United States remains a massive energy producer, the global supply chain is suffering from what I call the Hormuz Premium. Because energy is still largely settled in US dollars, every foreign nation is now paying a double tax. They pay for the high cost of the crude itself, and then they pay the premium of having to acquire expensive dollars with their rapidly weakening local currencies, the yen, the euro, and the lira. This is the final, most violent phase of the dollar milkshake theory. The world is being forced to sell its domestic assets, stocks, bonds, and real estate just to acquire the dollars needed to keep their power grids from going dark. This makes the DXY look strong, but it's the strength of a vacuum, not a healthy economy. Now, let's pivot to the opportunity. If you've been following my minor math segments, you know that the current setup is a once-in-a-century anomaly. As I record this, gold spot prices are trading at $5,014 per ounce. This is a psychological and structural breakout that has left the paper shorts in absolute ruin. However, the great disconnect persists. While gold has doubled in value over the last 2 years, the major mining companies, the producers who actually dig the metal out of the ground, are trading at valuations that suggest gold is still stuck at $2,200. Let's look at a producer we'll call Equinox Peak Resources. Their all-in sustaining cost, AISC, is roughly $1,950 per ounce. When gold was $2,400, they made a respectable $450 profit. At $5,014 gold, their profit margin hasn't just increased, it has exploded to over $3,060 per ounce. This is a 580% increase in free cash flow. Yet their stock price has only moved up 45%. The institutional big money is still trapped in overvalued AI tech stocks, but the rotation has begun. When these mining companies start reporting their Q1 2026 earnings, the wall of capital that will hit this sector will be unlike anything we've seen since the 1970s. Silver is the wild card of the 2026 collapse. While gold serves as the sovereign shield, silver has become the industrial oxygen of the AI and green energy infrastructure. Every high-density H200 chip cluster and every next-generation solar array requires physical silver for its unique conductivity. As of this morning, silver has officially breached and held the $80.38 mark. The silver-to-gold ratio, which historically sat at 80-1, is now crashing toward 40-1. This is happening because we are in the fourth consecutive year of a massive physical deficit. We are short nearly 290 million ounces globally. If you are holding paper silver through ETFs, you are holding a claim on a metal that might not be there when you call for delivery. In my portfolio, I only value physical integrity, metal that is either in your direct possession or held in non-bank high-security vaults in neutral jurisdictions like Singapore or Switzerland. When the debt spiral forces the final monetary reset, silver will not just be expensive, it will be unavailable at any price in the retail market. Final strategy. The three pillars of 2026. To conclude, the global debt death spiral is not a disaster to be feared. It is a process to be understood. It is a massive transfer of wealth from those who hold promises to those who hold provisions. To survive the remainder of 2026, I am adhering to three strict pillars. Zero sovereign credit. I am holding zero long-term government bonds. Being a creditor to a bankrupt superpower is not an investment. It is a donation. Tangible production. I am heavily overweight in companies that produce energy, food, and metals. In a currency crisis, the world stops caring about price to earnings and starts caring about price to atoms. Self-custody and decentralization. Whether it is Bitcoin, which is acting as the digital collateral layer, or physical gold and silver, you must remove the counterparty risk. If you need a bank's permission to access your wealth, it isn't your wealth, it's their liability. The mathematics are final. The spiral is accelerating. Ensure your family is positioned on the right side of history. I'll see you in the next update.